Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, contrary to rumour, I am still alive and I am well aware that it's been a month or two since I've updated YouTube. I'm sorry that I'm neglecting you guys, but on that note, a quick life update. Now, I've mentioned in the past that I am a stay-at-home father. I'm currently in the process of raising my second child, who is he was two months ago back in April, and he will be starting nursery this September. Now we're going to start slow, obviously, ramp it up gradually, get him used to the place, but I've got a feeling he'll absolutely love it. And a month or two after that, towards the end of the year, I'm sure he'll be settled in, and I will be reclaiming several of my afternoons. Those afternoons will be put back towards creating content for YouTube and additional content for my already very patient and supportive patrons, who at the moment get all of my time, hence the lack of videos here on YouTube. I just completed a 3-hour stream today, a live stream for my patrons, where I looked at multiple stocks and multiple cryptos. Doing the best I can. I still produce a monthly dividend calendar and stock rating system, and I still put out updates as frequently as I can find the time to do so. So if you want to get access to all that extra content, including all of the Elliott Wave educational material and trading educational material, which could basically keep you entertained for weeks and months anyway, going through all the back catalogue of that stuff, then feel free to join, support me, and pay that 10 quid a month, and you only need to pay it once and you get access to all that stuff. You can always leave afterwards. Now, I'm only saying that because it is genuinely the best way of getting access to any additional content which is not currently going to be or won't be available here on YouTube. So there's a quick life update. I'm still very much balls to the wall, full-time parent at the moment. That situation will improve at the end of the year and I will have more time on my hands, and when I do have more free time I will be putting it into producing more YouTube content. So let's do a recap of Bitcoin today. Okay, so let's start here on the weekly time frame on the VLX, and we're going to do a proper recap here, breaking things down. Just in case you're new to the channel or you haven't considered the long-term technical analysis of Bitcoin, we're going to start with that first, and then we'll come into the count in a little while. So, first thing I want to bring up is the market cycle here. These 4 years periods of bottom to bottom I'm using here. And we're going to bring up our bull markets, and we're going to bring up our bear markets, and we're going to bring up our crypto seasons as best I use to describe essentially the sentiment and the behaviour of the price action during these periods. So we have our first bull market here of 1183 days and into the highs of 2013, and then we have a 413 day bear market completing the 4-year cycle. We then have a 1064 day bull market into the highs of 2017 and a 364 day bear market into the lows of December 2018. We then have our next 4-year cycle beginning with a 1064 day bull market again, exactly the same length to the tick. And that brings us into the highs of late 2021, and then we have a 378 day bear market, slightly longer than the 364 day bear market in the prior cycle. We have now progressed into the next 4-year cycle, and going purely on the rough idea, the rough assumption that we will get something similar again of another 1064 day cycle. That's what I've used to project forward in time to find the top of the market, and we find that around October next year, 2025, and then we get another 385 day, slightly longer winter than the prior one, and that will take us into, now it could be longer, it could be shorter depending on the length of the bull market. The bull market could be longer, the winter could be shorter. The bull market could be shorter and the winter could be longer. I don't know, but this is based off of price cycles projected forward in time, because that's the best we've got to go on this macro scale, and that gives us a 385 day winter, and that will complete the next cycle. Now we can see that during these corrections, if we remove the crypto seasons for a moment and the correction lengths and bring up the actual corrections themselves, we can see that the severity of each major bear market reduces in scale over time. So we have a 93.7% decline, an 86% decline, 84% decline, and the last bear market was a 77% decline. They are all severe, but they are reducing in scale, along with obviously diminishing returns in terms of the overall gains. Now, the next thing I want to touch on is the behaviour of the price post halvings. So let's bring up the halvings here. So we have the halving here back on the 26th of November 2012. We go sideways for a while and then we erupt higher. Now, out of the entire bull market into the top of where our first major bear market correction occurs, our first major winter that we record, out of all of the gains of an entire bull market, 98.96% of all of the returns occurred post-halving. So if you were to take the entire rally, 98.96% of it happened after the halving. So the vast majority of it, resulting in a 9,517% gain. We then move on to the next halving on Monday, the 4th of July 2016, a few days before my birthday. Now, this represents a 2,875% gain in price from the halving to the high. Now we see that in this entire rally, from the low of January 2015 to the highs of December 2017, we see that 97.44% of all of the returns within that bull market occurred post-halving. So the vast majority of it again. Now when we come into the next cycle, we see that the halving occurred on Monday the 11th of May 2020, and the post-halving gain was 688.84%. And the entire move from the bear market low of 2018 to the high of November 21, the entire out of all of the returns of the entire bull market, 91.6% of those returns occurred post-halving. So you can see what I'm doing here. I'm beating you over the head with it, really, aren't I? I'm just trying to ram it home to get the idea in to people's heads. So we've now had the halving, and we've now gone sideways. Now, there is bearishness around in the market, there always is, but this is nothing out of the ordinary. So what do I mean by that? Well, let's have a quick look. So let's bring down to the daily time frame for a minute, and let's get a gauge on how long we can typically go sideways. So if the current low was the most recent low was the current low, we've gone sideways since the halving for 67 days. So let's come over and have a look at this halving event. So we take a look at this halving here, and then we go sideways to when we break out. We go sideways for 71 days, give or take. Now you could be a little stricter and say, well, what about once you break through the prior highs, in which case it's 77 days. But you take the point. Then if we move back in time to the prior halving, to that one, and we see how long it takes to clear those highs at the time of the halving, we won't take the prior highs, as I don't think that's particularly fair. So let's just draw a line, and then we'll say, how long did it take going sideways to come back to and through those highs? It took 110 days of going sideways. So you take my point. Okay, going sideways after a halving event is perfectly normal. Let's go back again and look at the one prior to that. So now we're going all the way back to 2012. So for how long until price actually aggressively breaks out? I'm going to be generous and not count this pivot. I'm going to count the highs here and say we'll stop right there. This is 46 days, a little less than the ones we've currently witnessed. But as you can see, it is perfectly ordinary to do absolutely fuck all for a while. Okay, now why is that? Well, if sentiment's got anything to say about it, it's because it's going to frustrate people. Okay, it's going to shake some people out, it's going to make some people make some very stupid decisions, and it's going to, yeah, for want of a better term, it's going to test people's patience. And that's the phase that we're in currently. But if we repeat what we did in the prior cycle, and the one before that, and the one before that, we will get 85-90% or so of all of the returns, which will happen from the low of November 22 up until the highs of October-November 2025. Then as much as 90% of that entire move will occur from now, from this time onwards. Okay, just before I move on, I just remembered one other metric to take note of. I don't think it's any significance yet, since we don't have at least 3 data points, but we will once this cycle is over, and that is what percentage of the prior post-halving move does this post-halving move represent. Now this was 24% of the prior post-halving move, and this one was 30% of the prior post-halving move. I'm not saying it's a significant or important metric, but I will be interested to see what it is and how it works out when we finish this cycle. Just a curiosity. Now, on that note, let's go back to how long we can expect until we complete this cycle. So until the next bottom, we're expecting the next bottom to come in around November 2026, and we're expecting the next high to come in somewhere around November or October, between September and November 2025. Okay, so more than a year away. So on that basis, how do we get up there? With an Elliott Wave count which makes sense. Now, I say up there, that's a price matter. How do we get there in time with an Elliott Wave count that makes sense? And that's the bit that is the rub, that's the struggle. So let's talk about the Elliott Wave count as we have it. We have several alternatives to the primary. I'm not going to discuss all the alternatives in this YouTube video. I did a video recently for my patrons where I went over those. So if you want to see what those are, you should sign up and go and watch that video, and I will keep people updated as and when things change. But we're just going to focus on a couple of ideas today, otherwise this will be far too long a video. So the primary count, I have a series of wave 2s, super cycle degree, and primary degree. Now I've covered in a video more than 2 years ago now why I believe this, and everything I said in that video is still absolutely valid to this day. Okay, you can probably find that on YouTube, but to sum up, essentially what we're seeing is the structure, the Elliott Wave structure of the corrections. What we call a corrective form is a form which contains no new price extreme within the correction. What does that mean? Well, in each of our winters, so to speak, we have a zigzag, a sharp pattern, a zigzag of some variety, either a simple zigzag or a slightly more complex zigzag, but it is a 3-wave move and a sharp decline with no new price extreme. Now if this was a 1 into a 2 into a 3 into a 4 into a 5, as was being espoused for a very long time prior to making new highs, obviously you really are stretching things now if you believe that's the case. It's not impossible, but there was a lot of people who did not think new highs were coming, and I was in favour of new highs from very early on at the end of the bear market. Why? Because I saw this corrective form being repeated over and over again. The lack of alternation and the expected behaviour of the wave 3s subsequent to these wave 2s did not materialise in a way that I would expect given my understanding of Elliott Wave, and therefore it is far more elegant a solution to simply create an extension, a wave 3 extension. This is after all still a very, very, very young asset class, and I don't care if you agree or disagree with that assessment, that is a fact. If you compare it to the 200 plus years of gold that we have price data for, or even compare it to the Standard & Poor's index or the Dow Jones, for example, this is a new and young asset class. Bitcoin has not been around very long, and it makes sense, just like if you look at the longer term assets we've seen even in the tech sector. For example, if you go and look at the Apple chart, I did a video on that and I've covered it in live streams not too long ago, where we looked at the long term count of those 1, 2, 1, 2, 1, 2 larger into smaller wave degrees at overlapping extension before it broke out into an absolutely biblical wave 3 of 3s. No one at the time would have believed it was possible. No one in their right mind would have believed those kind of gains were coming, because we can't see the future. But I believe the same is happening here in Bitcoin. We have a series of sharp corrections which are reducing in severity over time, from an 86% decline to an 84% decline to a 77% decline. And so therefore I am of the opinion that we are now entering the wave 3 at multiple degrees. So now we've got to get into that high, given a reasonable time frame. So let's just get a line in the sand as to where we expect that winter to begin. So what we'll do is we'll get a little vertical. Now I know this is very rough because we're projecting this based on prior cycles, but it's all we have to go on. And we're going to add some text. We're going to change it into a white line. Oh no, that's the text, sorry, excuse me. We'll leave that yellow then, shall we? And we'll say finish line. And we've got to get across that finish line. Okay. Okay, so here's our checkered flag. Here's our finish line. So how do we get there? Right, with an Elliott Wave count that makes sense. So how about we observe some previous price behaviour? Right, because here are our options. I'm going to lay them out super duper simple for you. We are either 1, 2, 3, 4, and all of this is going to be the 5th. Right. Now this has got to get us higher enough up. We've got to go high enough, right, as a target to get a primary wave 3 in, which leaves no danger of the wave 4 of the subsequent year-long bear market winter of coming back into that structure. Okay. You see what I'm saying? The wave 4 has got to be able to retrace a typical amount for a correction, so maybe 60-70%. It would likely still hit a typical wave 4 retracement target, 23.6, 38.2, 50, and not come back into the prior wave 1. So if that's the case, it's going to have to go a pretty freaking long way up. You know. So are we more likely to achieve that in a wave 5? Given all of this time, or within a wave 3. Now my bet's within a wave 3. Now why is my bet within a wave 3? Now let me explain. We cannot use Fibonacci extension tools to project wave 3s within Bitcoin. Why can't we do that, Tom? Even in logs, surely it works. No, it doesn't. Not even close. Let me explain. Here is a wave 1 of the prior cycle into the wave 2. How high did we go in our wave 3? We went beyond not the 1618, which is a typical wave 3 target, not the 2618 or even the 3618. We went beyond the 423.6% extension, but fell short of the 650% extension here, right? Which is not actually a Fibonacci number, it's just an observation you will come to appreciate in a little while. But we went beyond 500%, maybe around 600%. That's more typical for a wave 3, but it's not necessarily ordinary in terms of how extreme it can be. So let's move back a little bit, shall we? Let's turn off a super simple count and let's bring in the primary. And let's do another wave 3. Got 1, 2 here, 3, 4 here, 5 into 1, into 2, into 3. We are measuring another primary degree wave after all. 1 into 2. This is 650% the length of wave 1. Not 1618, not 2618, not 3618, 423.6, 650% the length. So why don't we go up another wave degree? We've gone from intermediate here, right, intermediate 1 to 3, into primary 1 into 3. So why don't we go into cycle 1 into 3? Now surely this big strong cycle wave 1, this can't possibly be dwarfed by this wave 3. Well, let's see. Oh look, it actually goes beyond 650%. So what have we established? We've established that the vast majority of the work occurs within the wave 3. How about we take a minor wave degree, right? We've done intermediate, we've done primary, we've done cycle. Let's take a minor wave degree within the last bull market. Here's 1 into 2 into 3. 363,618. And that's actually beyond 3,618, and that's just a minor degree. All of our larger wave degrees have smashed typical wave 3 targets. So where does our current wave 3, if that's what you think is happening, measure up? How does it measure up next to all those prior wave 3s? Well, let's have a look, shall we? Let's bring up that super simple count again. Now let's put in that little bit of detail. Let's say the 1 into the 2, and now you think the 3 is in. The 4 is probably happening as a flat or a triangle. Okay, something like that. Maybe it's already in and this is 1, 2, who knows. But either way, how's it look? Oh, let's measure. 1 into 2. It doesn't make it to 3, 6, 1, 8. It barely makes it past the 2, 6, 1, 8. It makes it nowhere near the 423.6 or the 650% targets we've seen before. Okay, and we are measuring this, remember, on the logarithmic chart. These are adjusted for that. Okay, I've accounted for that, so don't jump out of bed and say, well, that's not how it looks on my chart. Okay, let me show you what I mean. Alright, fib levels based on log scale is switched off. These are linearly adjusted for the log chart. Okay? So that's why I don't think we can use Fibonacci extension targets, okay, as a means of measuring our wave freeze, because I don't think it's realistic. Now you say, why aren't you using it in log? Right? The reason I'm not using it in log is because it's not a logarithmic measurement. Okay, the distance between 2 points is a linear measurement. The difference in price between 2 levels is a linear measurement. Alright? We can adjust for log, right? But we want to get an idea of how strong this wave 3 is in real price terms relative to all the other prior wave 3s we've discovered or experienced in prior cycles. We want an appreciation, we want a direct comparison. And that direct comparison, this wave 3 falls awfully short of all those prior examples. And therefore, your only explanation, if you're going to believe this, is that the wave 5 has to be the extension. The really proper extension. Now, I'd agree on that grounds. If you are going to label this 3-4, this 5's got to be monstrous, utterly monstrous, because it's got to pull enough space for the top of the primary wave 3 to complete, so that the primary wave 4 can't invalidate this high. Right? It's got to get. That means it's got to go big time styly. So if we were to pick a target, like some people are saying, like 100k, which I've heard thrown around. Here's the wave 5. So how do we get from here to here and have anything resembling an impulse? We don't, do we? Right? So maybe this is an extremely long time wasting diagonal? Okay, maybe it is. Let's put in our wave 3 then. How much room have we got for our wave 4 to come back without invalidating our wave 1? Doesn't look like enough to me. What kind of decline? Typical 60, 70, 80% decline, yeah, into a winter? 33%. Seems a bit suspect. Oh no, that's at 109,000. Sorry, let's bring it down to 100,000. 28% decline. Seems a little suspect to me. Doesn't look like a believable wave 4 retracement. What if we were to put the fib retracement tool in at 100k? Where's a typical retracement for a wave 4, guys? It's at the 23.6. That's the minimum. Oh, wait a second. We're into the wave 1 high. Oh, what about the 38.2? Oh, yeah. What about the 50? See what I'm saying? If we're going to get a typical wave 4 retracement, right, which comes back to a level that we can believe is, what's the word, is reasonable, then I think much higher targets are going to be necessary. Much higher targets. And that's only assuming that the wave 4 itself does not. Let's put that there. That's about 300k. Let's take this extended 5th wave, plonk it here, put the 3 up here, put the 5 up here. Now let's see how the larger wave degree 4 would look if it came back to the 23.6. Maybe give it a year-long bear market again. You say this is not an exact science, guys. Okay, I'm dicking about here, but I'm just trying to make a point. Okay, how's this look? Sure, let's take it in. Let's take it in, given the whole prior structure. Shall we? The whole prior. So here's wave 1, here's wave 2, here's wave 3, here's wave 4, here's wave 5. I think now you're cooking, right? Now that looks believable. Maybe 500,000, maybe 1 million for the wave 5. Who knows? Maybe the crowd's not even showed up yet. But let's just say 500,000. 1, 2, 3, 4, 5, and that would bring us into cycle wave 3. God knows, out towards the end of the decade. Okay, that looks believable to me, and that's coming from 400 odd thousand. Oh, sorry, no, it's not. It's coming from 300,000. Excuse me. So I think targets of 250,000 and perhaps even in excess. And for God's sake, these are very rough guidelines, and I don't know when and how these future bear markets are going to play out, what wave degrees they're going to be completing. My suspicion is that the next bear market will be the wave 4 at primary degree, and then the following bull market will be the completion of the larger cycle wave degree, and then the next bear market will be that cycle degree wave 4 correction. I hope all of that makes sense. Now, this is all speculative, but you see what I'm saying. If you believe that's 1, 2, 3, 4 already, then we've got to make 90% of our gains of the entire market. Remember, 85, 90% if we behave like the prior post-halving moves has to come from now. And I don't mean a 90% gain in price. I mean out of the entire move from the low to the high that this market will comprise of, this bull market, 90% of it will occur from now. So this is the magnitude we're talking about. So there's your first option. 1, 2, 3, 4, and we come up here in a massive fifth. Now here's my alternative. Here's my primary that I believe is more likely. I believe, given the amount of time we've got left over a year to get up there, and the amount of ground we've got to cover, we're going to have to do it as a wave 3, not a wave 5. And therefore, I see this primary count as the correct one. Now, the one thing that's up for debate is the position of this wave 2. This wave 2 could be over here. Right, and it's not in yet. That's possible. For the meantime, we've got a closer invalidation point. Like I said, I recently covered a whole bunch of alternate counts on a Bitcoin video I did on the Patreon, which you can sign up to and access yourself if you want to. I'm not going to go over them today. It's going to take too long. So here's the super simple count again. And let's do it this way instead. Now, I've switched into linear because if I keep zigzagging up in never-ending extensions on the log chart, we're going to end up at $1 billion, and I don't think anyone will believe that. You know, not even BitBoy. But either way, let's get on with it, and let's just say that we are going to go 1 and 2, 1 and 2, 1 and 2, and then we've got to get something equivalent to a wave 3 to this length here, so maybe that looks about right. 3 and 4, 3 and 4, and then the blow off fifth, which tends to be a very explosive move. Is that sufficient to get us further enough away? You know what? I don't think I've been generous enough. I think I've got to drag that up higher. 3 and 4, 3 and 4, and then 5. Even then, we're not quite making it to 300k or so, but maybe now, maybe if we switch back into log, we can believe that's a viable place for the wave 3. Let's just pop it there and see how it looks. Let's take that wave 4 retracement. 38.2 would invalidate the wave 1. It doesn't seem high enough. If this is all going to be primary wave 3, that doesn't seem high enough. So let's make that extension even more extreme. 1, 2, 1, 2, 1, 2, 3, 4, 3, 4, 5. Maybe a bit too much, maybe not enough, who knows, but let's drag it down so the 4s overlap. How about that then? That brings us up to 380k. Could be way too much, but at least now it gives room for the wave 4 to retrace and not come back into the wave 1. That's why I believe, given the more than a year we've got left, a year and several months now, that we've got left, I think it's more likely we're entering a wave 3 extension. And people have already, I've already had people ask me, well, why is the 1 and the 2 and the 1 and the 2 so far away from the primary 1, 2 that we've seen? Okay, believe it or not, that's actually very normal. Alright, if we go back and look at this wave structure here, what do you think these first waves here are before these ones occur? Right, these are wave 1s, and they're a long way from our initial wave 1 into 2. So they keep going on for a fair old while, and they keep getting longer and more extended. So I'm not saying this is definitely right. Okay, I'm saying it's my preferred explanation for where we need to end up. if things repeat themselves. It's a big if. I know it's based on assumption, but it's the best thing we've got to go on. So on that basis, let's now come in and spend just 5 minutes looking at the Elliott Wave counts in more detail. So here we are coming in on the tick chart, and we're going to look at the prime rate. Okay, and we're going to come down to the 8 hour so we can get a little bit more detail. Now, as it stands, 1 to an intermediate degree, 1 to at minor degree, 1 to at minute degree. I'm not sold. Okay, I'm not sold yet that this is a low, and this could be invalidated, and if we fall below 56,500, this is invalidated, and this too will be moved over to here instead, and this will be a larger correction at a minor wave 2 degree. Now what I want to use as a rough guideline is if I just take the length of the prior intermediate wave and I just superimpose it over here, we can see that we are still well within the confines of that intermediate wave 2 and still finish a primary and a minor wave 2 within inside the confines of that time limit. Why is that important? It's not essential. We can have larger corrections at smaller wave degrees. Part of its price structure, corrective structure, and part of it is the whole getting stretched out like an accordion. In these exponential markets, things just get bigger rather than smaller. But I would still like to see it finish within that time frame, and we could come down lower, perhaps as a flat pattern. That's one of the options. So don't run away with the idea that it has to be 1-2 already in and 1-2 again. It's just a temporary count. It may be right, but I use the closest invalidation point I can so that the data gets updated as soon as possible, and that's at 56,500. If we breach that, we'll move that 2 across. We'll assume a different corrective structure. Okay, but at the moment we have 1 into 2, and then we have 1, 2, 3, 4, 5 into 1 into 2 as a triple zigzag, and another 1, 2 building up off of the low before we move higher. That's the primary count. Now let's look at that alternate idea. So here's the alternate idea using the intermediate degree pitchfork. Now I'm using the pitchfork here off of the 1 into 2 pivot because if this is the wave 3, I will admit it has a pretty nice look to it. Alright, it's not a strong wave 3, we've established that, but if we're going to have a stupendous 5, it shouldn't be strong. Remember, that's the whole point. Validating your own or my own argument, or whoever agrees with it. Put this all the way up at, where's quarter mil? Quarter mil at the median line, please, Bob. There you go. That's where the wave 5's going, guys. That's quite a long way. But either way, it does fit. I won't argue. Now there's a whole panoply of ways we can do it. Alright, we could insert a triangle into here and still be within the, well, maybe just within the pitchfork. Put a triangle in. A, B, C, D, E. I don't know yet. You don't know yet. Alright, we could have a flat pattern in here. Right, and then we can squeeze that into our alternate one. Put the 4 over here. Okay, finished at the edge of the pitchfork would be 1 to 1. Pretty nice look to it. And maybe we go A, B, C, regular flat, 5 waves down, done, and off we go. And then we start this 5th and final blow off move. Okay, I don't know where the finish line was now, guys. I've lost, I don't know, because that's on the other chart, but you take my point. And those are 2 different counts I can see at the moment, with the alternates within them. So, to sum up, the primary still assumes 1, 2, 1, 2, 1, 2. The latest minute degree wave 2 will invalidate at 56,500. The first solution to keep this count alive is to simply move the 2 across and await a pivot. Await a pivot to occur. That's the primary. I'll update my patrons as and when and they need to be once it happens. Alternate count is this is 3 into 4. And since we still have an internal correction below this low, there's a series of options. It could be a triangle, which is yet to play out. It could be a flat. Okay, and that's where I'm going to leave you guys today. With the Elliott Wave count, we are going to have a quick look at the daily time frame classical analysis to get a feel for what the price is doing. So On the RSI, we came down to oversold conditions. Right, 17.69 on the RSI, pretty low. And we started to move away from oversold conditions. Could be a completed 3-wave correction. Could be one more low required with bullish divergence into a higher low. That would be quite normal for a wave 4. So that flat pattern, 1, 2, 3, 4, 5 could be playing out 5 waves in a C, but this could be 1, 2 off the low, just off of oversold conditions. MACD, bearish momentum is waning, pale red bars, average and signal lines looking to cross over, long way below the zero bound. Momentum should pick up, take us through the zero bound and off to new highs, if we're going to push into a wave 3. OBV, broken a downward range and an upward trend, suggesting that this was indeed a larger wave 1 into 2 or 3, 4. It fits the idea, however you want to look at it, of a larger wave degree structure of either minor or intermediate degree. It could be minor 2, it could be intermediate 4. I'd argue though that this is a massive structure in the OBV and this is smaller. One would expect them to be of similar scale if they were intermediate degree, but it's not impossible. So could be intermediate 3 into 4. Either way, it's a zigzag. But we've broken this range. So to come back into, test this range back and through and carry on in the bullish cumulatively bullish volume would be a very strong signal that we're going higher. So for the meantime, oversold, bearish momentum is waning but not necessarily over. There may be one more low in the tank, but there isn't much more. In my opinion, there isn't much lower to come. We could already be bottomed, and if the primary count's correct, it has already bottomed. If not, we'll adjust it. Okay, so moving averages, where are we? Still above the 250, which technically tends to get tested at larger wave degrees. Here's a larger wave degree 1-2 test. Here's a smaller wave degree 1-2, which hasn't tested yet. But if it's 3 and 4, I wouldn't be surprised if it does. So we're going sideways, no shit Sherlock. We'll be doing it for a while. It's getting pretty bloody tiresome, I understand, but it ain't going to go on for much longer. And since we're in this sideways box structure, so you can call it a rectangle, whatever, it's a sideways consolidation. 2/3 of them, at least 66% of the time, we break out in favour of the prior trend that entered the box. Up, sideways, up. 1/3 of the time, it was a topping structure and we break downwards. However, the argument against it being a topping structure, okay, this wave, this high here is lower than this high. A double top tends to have a bias towards finishing at a 5th wave before breaking down violently. So we would tend to see this is the 5th and this is the 3rd and this is the 4th, right? Rather than 1-2, 1-2. If that's the case, this would be a truncated 5th, which is quite uncommon. The only alternative, right, for the double top is that this is 1 and this is 2 and this is the 5th. Well, that does not look like a motive structure to me, lads. So I'd say that option's far less likely. So, in favour of the fact that we got lower highs, not a completed impulse to a new high at the same wave degree, and that we don't have a particularly strong motive structure down to here, maybe there's a diag. Maybe there's a diagonal. Maybe that's your only hope and your only bet, that's 1 and a 2, to get a lower high rather than a higher high. That would favour the 33% of the time in which it breaks down. However, the fact that these are lower highs, and we are entering from a below, gives you a 66% probability, if not higher, that we will break out to the upside. There you go. It's all probabilities, but we will wait and see. And thank you very much for joining me, guys. I know it's been a long time. If you like what you're seeing on this video and you're new to the channel, please subscribe. Give us a breath of life, because I am struggling to get the content out for you guys at the moment, but I will improve that in the future. And if you're interested in seeing more of what you've seen here, please feel free to sign up to the Patreon. Link is in the description box below. And go and unlock all the Elliott Wave educational material and teach yourself how to do all this stuff, so you don't have to waste your time listening to me rabbit on and on. Alright guys, take care of yourselves, and I'll be back with you as soon as I can. All the best. Bye bye.